Hi, and welcome to Beyond the Lot. I am Kevin Timson, a dealership attorney with Arent Fox Schiff, and we are here today with David Harkins. David is a vice president at Mercer Capital, and Mercer Capital is a great firm, nationally recognized, one of the leading valuation firms in auto retail. And just going through your CV a little bit, David, it's a pretty impressive CV here. You're a member of the auto dealership team. You work also with a litigation group, providing valuation for litigation, as well as for marital issues, as well as for buy-side advisories. You are a chartered financial analyst, certified public accountant, accredited in business valuation, certified in financial forensics. So do you plan to keep adding those certifications, or?
No, you need to stop at some point. I debate sometimes because I think sometimes it looks like all I'm doing is being good at taking tests. So, sometimes I'm like, maybe I'll only show 2 instead of 4, but that's where we are right now.
It's okay to do that. I got I got my bachelor's degree, then went back, got a public master's in public administration, and that wasn't enough. I had to go back and go to law school, and here we are. So, but I can vouch, just for myself, I am not going back to school. So,
Well, I just did the CPA last year, actually.
Okay.
So never say never. It was something
Yeah.
that, I didn't really think I needed. And some local attorneys told me that they would, they prefer their experts to have it. So I figured I could either spend my whole career explaining why the ABV is the valuation credential instead of the CPA, or I could just go ahead and get it. So I took the year and got it. And, here we are. So
Fantastic.
never say never.
Never say never. Okay, you're right. Never say never. I'm not gonna say never. So, well, once again, welcome to the Beyond the Lot podcast. Just getting a little bit of background. I know we spoke before, and I'm obviously very familiar with your group. How did you get involved in supporting automotive dealers? I know that you've been involved with other industry areas, and I also know that you do a great blog, and you do a great newsletter. I'm an avid reader of it, and that you're one of the main supporters on that, the main providers on that. Tell me a little bit of how you got there.
Yeah, sure. So our firm has always been big into content marketing, making the phone ring. So I actually started with oil and gas. The way it kind of works at our firm is you start with something you're supporting, you're kind of like learning the how-tos of marketing at Mercer Capital, and then you end up kind of either by the luck of the draw, you like the industry you're in, or you end up covering a different one.
Sure.
So I started in oil and gas, but when I moved to Nashville, I switched gears and started covering auto dealerships, building that out. Taking what I learned from the content generation on the oil and gas team that had kind of been in place for a few years, and really we built the auto dealer team from the ground up. My mentor in Nashville did a fair amount of auto dealerships and litigation, so I just followed him. I know a lot of attorneys understand that, of kind of following a partner and kind of doing what they do. So that's what I did, and we helped build it together. We launched the blog in March 2020, and it's been kind of a wild ride ever since.
That's great. That's great. I mean, it kind of echoes what I've done. I mean, I started off mostly on the transactional side. Once I started becoming an attorney, mostly involved with healthcare. To be honest with you, I didn't enjoy it quite as much as I enjoy the automotive segment because there's a lot of family businesses. I know we spoke about how that kind of impacts evaluation and the need for valuation and things like that. But I, similar to you, I started working with a firm where I was mentored by someone who really only serviced dealers for the most part, but it was a great experience. And certainly coming here to Arent Fox, it's, we have one of the largest auto dealership advisory groups in terms of legal counsel, and it's been great. So, so glad to hear it. One of the things I know we spoke about, and I wanted to talk with you a little bit, is there was a great white paper that you produced recently on value drivers for an auto dealership. I think it's something that, whether you're buying or selling or you're just kind of reassessing your business, it's always important to understand really, from an outsider's point of view, what people look at when it comes to the value of your business? Because, very often I'll represent sellers, who will come in and say, "Hey, you know what? I think I can get XYZ for this dealership easily." And then they come back and they say, they see something either from, someone like yourself, or, a buy sell advisor, or even from an offer, and they're very surprised. So tell me a little bit about what some of those drivers are, and, how they interact with each other to produce a specific result.
Yeah. So I'll start just kind of maybe broader, just for all valuation. The
Sure,
founder of our firm, Chris Mercer, I like to say he would be on the Mount Rushmore of valuation practitioners, getting into it in the '80s, uh, when the industry is really kind of becoming what it is. What he always impresses upon us is, if something's going to affect the value of a company, it needs to affect either the cash flows, the risk, or the growth.
sure,
Sometimes it impacts multiples of those things. So that's just kind of broad, not just dealerships. But when you
sure,
talk dealerships specifically, I think one of the number one determinants is the OEM, which a dealer, once you have your store, you can't really change that. You can add a store, you can
sure.
divest a store from your group, but there's not much you can do there. And there's a little bit of ebb and flow to that. You can look at the multiples that Haig and Garrigan put out there, but uh, really, you know, they're not going to be the same 5 years from now. Quarter to quarter, there might be a little change, but if you look back, Toyota's had a great run recently. Kia and other stores have really kind of improved. So, it's not a forever thing. Just because you have a
Sure.
low multiple dealership doesn't mean it's going to be low forever, because things ebb and flow. And the whole idea, at least from my perspective, is that as a dealer, you can't change, the product that your OEM is rolling out. So, if they just go full into EVs, or they don't do it at all, you can be missing the market in either direction. If they have a bad lineup, they stop doing crossovers, whatever it is.
Yeah.
You don't really get to control that. You do your best selling the product you have available, but when you can't change that and the incentives and things like that, there's limitations on what you can do. But outside of I guess what some might say the obvious, some of the other factors that are important for dealerships would be the real estate. Again, you can move your store. That's a pretty difficult endeavor. It's somewhat unlikely to change. So I guess
Sure.
if you want to focus on the value drivers you can really impact as a dealer principal, that'd be building out the depth and skills of the management team and employee base.
Uh-huh.
Making sure that customers who come in the door are having a positive experience, making sure if you were to go on vacation for 2 weeks that the store doesn't shut down in your absence. There's things you can do to reduce the risk, and make have the cash flows be more regular, predictable, by investing in your fixed ops, where there's higher margin and recurring revenue, things that ultimately a buyer is going to be interested in. So those are a few of the things that I think that you know dealer principals should be focusing on. Many are difficult to control or out of their control entirely. But
Sure.
again, if you want, getting a higher valuation is either higher earnings or lower risk. So investing to make your operations do one or both of those things is going to be a good long-term play.
Could you give me a specific example of like a typical dealership, and, so how those drivers might influence its value? Yeah, and it's also interesting that you spoke about, some of the different brands that have kind of, shifted back and forth. I mean, Toyota's been, a great example where they've previously had, a pretty good position, and, maybe, people took it, didn't understand that, or underestimated that, but, obviously they've come roaring back. And you mentioned Kia, and, obviously we've seen some, concerns in the past year about Nissan. But if you're walking, regardless of OEMs, if you're looking through, and, a typical dealership, how, since we're speaking with a lot of, dealers on this blog itself and on this podcast, you walk me through it, like a specific example, and it, could even be hypothetical.
Sure. So like you say, you can't really change your OEM. It's
Hmm.
difficult to relocate your facility. So to focus on what you can change for the dealership you already own, while you can't change your competitors as much as you'd like to sometimes, and what their strategy is, whether they're pumping volume and and sacrificing on price, you you can't change your, local customer base as much,
Sure.
and what they're interested in. You can't change your, obviously as an investor, you care about after-tax cash flows and, you can't really change that either. I think what you can control is your go-to-market competitive strategy. So what I was
Sure.
just talking about with, maybe you can't control what your competitors are doing, but you can control what you're doing. And, you can chase margins and or volumes, but how quickly you're turning your inventory, maxing
Sure.
out your SSI scores, driving activity to service and parts, not just the variable side, because, it's called the variable side of operations for a reason. So if you're contemplating a sale, dealers need to focus on what they can control, and that's kind of, your personnel, which is a big part of the expense base.
Sure.
It's how they're interacting with customers, those processes, and making sure that customers keep coming back to the dealership because I think this is true of all businesses. It's much easier to have a customer come back than it is to create a new one. So
Sure.
making sure that their experiences are good the first time and they keep coming back to you, selling four, five, six cars to the same family. That's definitely a win and something that dealers can control because the family's already demonstrated they're willing and interested to buy your product. So keep them in house.
Sure. No, I mean, that makes a lot of sense. I mean, it's really a multi-pronged approach, and you're looking at all areas of your dealership, whether look at the front end or the back end. Certainly from a service standpoint, there's a lot of things that you can do. And, from personnel, making sure you have the right personnel, making sure they're doing the right things, whether, it's the variable part of the business or fixed ops. But that makes a lot of sense. Okay. Um, when you start working with a dealer client, and I know sometimes, that situation varies. Sometimes, they're looking to sell, or maybe they're looking to purchase another dealership, or, maybe there's litigation between partners. Might be litigation in terms of a divorce or something like that. Um, if they provide you with a factory financial statement, what are some of the things that you look at first to, assess the value of that dealership?
Sure. So on page one, you have the balance sheet, shows the accumulation of earnings over time and the current financial position. You can see how inventory is financed, how much. You can see whether the real estate is leased or owned, whether they have above or below working capital standard figures. Uh, they vary from OEM to OEM, but many of them include the number of vehicles retailed on the first page, and if not the first,
Sure.
it's surely on the second. Uh, so they want OEMs want to make sure their dealers are well capitalized and how many vehicles they're selling per month. Uh, I'd be curious how far they go past the first page, because I think there's a reason they pick the things to go on the first page, so what they care about is sort of all up front. While the balance sheet's important, most investors in auto dealerships, as opposed to the OEM perspective, investors are cared about earnings or cash flow. So they're more
Yeah.
likely looking at page two where you see the full income statement.
Yeah.
Uh, and these part of the reason I love auto is it's so data driven. There's so many different ways you could parse a factory statement. So if you're following the industry, when we do our valuation work, we have to do a management interview for due diligence, of course, to understand the
Sure.
why behind the numbers. But you have such a farther along starting point when you have these factory statements because there's just so much you can analyze and we could say, hey, I noticed this trend, here's the national trend and here's how you seem to fit into it. And when we ask those kind of questions, there's kind of a breath of fresh air for the dealers who are like, okay, this person understands my business. Not fully. We're never going to understand as much as them, but I think they understand and can appreciate the level of questions that they're getting. That it's not just, well, tell me about revenue. Because if you're starting
Yeah.
the conversation with revenue, you might not know as much about the industry. So yeah, so going back to some of the things that are on the statement that we're looking for, they help us benchmark to peers. We can say, okay, how's your gross profit contribution? Is it coming more from fixed or variable? We can look at your rent to gross to understand,
Sure.
how much you're having to spend on your facility. Of course, if it's to a related party, maybe there's some adjustments necessary, but generally, this data helps us benchmark to peers, so we can say, okay, if your store is this multiple. Should I be on the higher or the lower end based on how
Yeah.
I'm performing? You couple that with, local dynamics for, are you the only store in that market versus are there 3 others? We put ourselves in the shoes of hypothetical buyer and say, "Okay, what multiple would I pay?" Or, we also look at it from an income approach saying, "What rate of return would I want on this investment? Do I need, am I
Sure.
really confident in its earnings? I'm willing to pay more. I'll accept a lower rate of return because I'm just so confident the earnings are going to be there. Or do I
Yeah.
say, yeah, you've had a couple good years, but I don't really know for sure what it's going to look like longer term. I don't know how confident I am in, the manufacturer. So maybe I require a higher rate of return on these same cash flows, and therefore
Sure.
I'm willing to pay a lower value."
Yeah, I mean, it's interesting depending upon the buyer, you're gonna want to some buyers want to be, the money person and kind of leave the, management and the operations to the local team. And then some buyers are going to, want to kind of get their hands dirty. It's almost as if they're looking for a bad set of financial statements where they say, okay, I can come in here and do this, this, and this. And all of a sudden, you have better cash flow, you have, better working capital. You can change. All of a sudden, you have better floor plan terms, and so that's affecting your costs and your income, your income statement, and things like that. But have you seen those kinds of situations as well with buyers, or do you typically find, the buyers want to kind of take take the take the dealership that they see and the financial statement they see and kind of make the assumptions going forward, that that's going to continue, or and try to avoid drastic surgery.
So I mean, I think you're getting at a really interesting point there. I don't think buyers are a homogenous group.
Sure.
Uh, just taking it out of auto for a second. So we recently did a renovation on our house, which I think probably in some ways dropped the value of what it was because the top bidder for our house was going to knock it down and build 2 big houses on top of it. They just wanted the
Sure.
land, you
Yeah.
know? Well, when you add on to it, at a certain point, our land has effectively come so expensive, it doesn't work. So
Hmm.
you've changed who the buyer is.
Sure.
So you have a steady dealership, cash flows, it's cash flowing. You can walk away. You've got a great management team behind you that it can truly just be, as much of a passive investment as can exist. Obviously, uh, in privately held businesses, that could be overblown sometimes.
Sure.
There's always someone's got to be looking after things, but I think it depends on the buyer. So some people who want to come in and really operate the store themselves, they're more focused on revenue, volume, and they're not looking as far down the P&L because they're going to change it.
Sure. Yeah.
They're saying, okay, I know what my expense base looks like for a store that does this in revenue. You know, how much higher can I, how many more cars can I sell? How much can I drive fixed stops? How much, under my structure am I going to be paying for all of these other expenses? If you
Sure.
already have a family of dealerships, okay, which expenses get, eliminated? What are some synergies that maybe a single store operator doesn't have available to them? So I
Sure.
think, all stores may have a buyer, but they might not all have the same buyer.
Sure.
I don't think the publics are going after the same stores that someone who's been a GM for 10 years and wants to go in business for themselves. They're just in two totally different markets. So, I think
Absolutely.
that's what I'd say.
Yeah, I mean, that makes total sense. I mean, depending upon, how many stores are involved as well, because, you mentioned, for example, single point stores, and, certainly the Publix and some of the larger privates are not going to be looking for single point stores. They're going to be looking for, a regional player who might have 10, 15, 20 stores, and have an existing platform and kind of integrate them into, the buyer's existing business. Right. So, but that makes total sense.
Yeah,
Okay.
and operations are probably more professionalized with the larger group.
Hmm.
Another way that I kind of think about it is, whenever you look at things on Wall Street, they always say like, non-recurring, like one-time thing. Like
Yeah.
deal costs are always, written off. Be like, well, that was a one-time thing. Well, if you acquire 20 different stores all at once, you have to do diligence on each one. That
Yeah.
that non-recurring eventually does kind of matter. So,
Yeah.
yes, you're gonna have to spend a lot more time diligencing 20 stores, but there's probably some efficiencies when you're
Sure.
looking at it from that level as opposed to doing 20 one-off deals. So, yeah, I think
Yeah.
that's another thing to kind of consider in line with the fact that, the economies of scale that just comes with buying a larger group.
Yeah, absolutely. I mean, anytime you're going to see whether it's a regional group or whether it's a larger kind of nationwide group, they're going to look for, economies to scale. They're going to want to say, okay, what are some of the back end operations, whether it's fixed ops, whether it's financing, accounting, accounts receivable, accounts payable, F&I, all those things, whether it's, when we say financing, not just the floor plans, but, having a good terms with, a lender, in terms of, interest rates and in terms of other, access to capital. Right. And so one of the things that, certainly with the, overall macroeconomic conditions that we're seeing in the economy right now nationally, interest rates are high. So that's impacting not only consumers, it's impacting a lot of the dealers that we talk with. And, it's funny, even talking to some dealers and, they want to get, a seller's note, to buy a dealership. And they're saying, okay, let's do, 3% or 3.5%. I have to kind of, say to them, well, that's not even something that the IRS will consider a reasonable rate these days because of, the prime rate that's existing out there. That will be looked at almost as a gift for tax purposes. So we kind of have to go back and
Yeah,
say,
you
okay,
got to be at least at the AFR rate.
yeah, exactly. At least at the applicable federal rate.
Mhm.
But it's interesting, and so, and you mentioned, things like non-recurring expenses, and certainly, I'm assuming as part of your analysis, that's going to be, looking kind of at the quality of the statements and saying, okay, here is something that will indicate, a continuing expense, a recurring expense, or, here are things that, just shouldn't even be on the expense report. And, sometimes that's for, smaller dealerships or, maybe even some, smaller groups or, medium-sized groups where you might have personal expenses or, maybe the rent factors are not, quite as aligned to what's going on in the marketplace. So tell me a little bit about the process when you go through that with a dealer.
Yeah, sure. So, we all the manufacturer statements look different, but our models are set up where we can kind of we can feed them all in. Some are easier to get in than others, but the real the test is kind of like the quality of financial reporting. So compared to non-automotive, uh, you know, there is more attention to the financial statements because you got to send them to the manufacturer monthly. So, that
Sure.
that is nice. If we're valuing something not as of year end, you still feel pretty good that generally the financial statements are pretty strong. But still there could be, quality issues and needs for normalization adjustments or add backs as
Sure.
they're sometimes called. So buyers understand and expect some level of add backs, but you know that's there's especially personal expenses, maybe even for smaller stores, but I think it's something that still needs to be quantified and shown. So when we're looking at, we're taking a longer term approach. We're not just looking at the last 12 months. We've got 5 columns for the past 5 years. You look at every single line and you can say, okay, what's different? It might be difficult for me to understand what should data processing expense be. There's not,
Sure.
that's not, and, and what goes into that line. All, dealers are going to have different interpretations. So
Sure.
how do I know if it's high or low? Well, I can look at it and say, well, 2 years ago, this expense was triple.
Mm,
Why? Oh, that was a one-time thing. We had a litigation. Okay. Well, it did happen. It happened, I'm not gonna say it didn't, but maybe we're gonna spread that expense out over 5 years or, if you
sure.
get hit by a hurricane, like maybe that's more likely in Florida, but if it happens to you in the Northeast, maybe we're saying, okay, we can say that's probably not going to happen again.
I've had
You hope at
clients.
least.
I've had clients in Hawaii or had to deal with volcanoes, volcanic
Yeah.
eruptions,
Yeah.
and
I mean, the
fires. I mean, it's
hailstorms in
just amazing.
Texas.
Yeah, yeah,
Yeah,
yeah.
there's always something. So I think,
Sure.
yeah, these are the kind of things we're looking for, and you know, candidly, it's a lot easier sort of at the gross profit level to do benchmarking. Looking
Mhm.
at individual expense items can be more difficult. Some of the bigger ones, we have pretty good data for. Have an understanding of what comp is for the high level employees. What rents more or less should be, and to the extent we don't, you can hire local like real estate appraisers to help with that. But on other
Sure.
things, you can just kind of look at sort of the total bucket and say, okay, you seem to have normal peer gross margins. However, your, earnings, or your margins are way lower than peer. Why is that? We can look for
Yeah.
certain line items and try to identify them as being higher, but sometimes we have to rely on management to understand. And they'll say, "Hey, we have way more employees than we need to operate this store, and that's
Yeah.
just kind of what we've done over time, and it creates a good environment. But if we wanted to maximize profits, maybe we'd let a few people go." That's something that is you can track how many people are on the you know in each department on the statements, but that those are the kinds of things where we're ultimately going to need to rely on management, and
Sure.
then just kind of confirm the reasonableness of what they're saying. If they say, "Hey, here are all these ad backs I have," and then now all of a sudden the pre-tax margins implied are 6%, we might say, "I don't know if you could really add back all those expenses," but you
Yeah.
know. And it can work the other way too. Sometimes the dealer principal is, very important to the store, and they're just taking it all
Sure.
as distributions instead of salary, and we have to come in and say, "Hey, like, if you walked away, you'd have to hire someone, and you gotta pay them. You gotta pay them to do the
X
job."
amount of
You know,
dollars. Yeah.
if not equity, so
Yeah.
you've got to factor that in too. So it does
Yeah.
kind of cut both ways, but more often than not, I'd say most of our expenses are, or most of our adjustments are normalizing expenses back to,
Sure.
more expected levels.
That makes sense. I mean, any good valuation is not only going to provide a number, right? Say this is what we think it's worth, but it's also going to, provide some good questions, right? That's going to help, any potential buyer, or even a seller who's just looking to prepare for a buy sell. It asks those questions, follow up, and understand, what's the basis behind this number? How can this number change either positively or negatively? What's the risk? Back to your point, right? You have cash flow growth, and risk, right? And those are the three kind of elements that are going to inform the valuation. How can that vary necessarily? So that's great.
Yeah, and yeah, I think one thing that I would add is, for someone who's looking to sell maybe in 2 or 3 years, not, tomorrow. Obviously this is, would be beneficial to me, but I think getting a valuation, in 2, 3 years before sale can be really helpful, because then you get
Sure.
an outsider's perspective of, hey, what does the market look like right now? Maybe it'll change, so your
Yeah.
multiple might be different, but just get a general idea of what is going to go into the process. And like you say, understanding from the valuation, hey, why was this risk factor high?
Yeah.
What can I do to fix this? Certain things where it's a positive or negative view, some things you probably can't change, but for the ones you can, spend the next few years, trying to improve those, if, lowering expenses, all those kinds of things. So I think getting that look 2, 3 years out can be really helpful. And then also, there could be tax advantages. So if you if you gift it to the next generation who,
Mm.
you hope to one day have it, if you give someone cash, it's just 100 cents on the dollar. Cash is cash. But if you
Yeah.
gift a minority interest in a closely held business, well, that person cannot control the business. They can't make any changes to it, and they also can't compel a sale. If you hold 10 shares of Apple stock, obviously you're not going to impact what Apple's doing on a day-to-day basis,
I
but
wish I did about 20, 30 years
yeah,
ago.
don't we all? But so but if you don't like what they're doing, you can sell it and get it in cash in 2 or 3
Sure.
days. You can't do that with a privately held business. So
Yeah.
there's discounts that are applicable to what sort of like the what it will sell for today value. So
Yeah.
there could be benefits to doing that transfer to the next generation, at a lower number. So then when you go and ultimately transact in the future, you've passed, more after-tax dollars, down to the next generation.
Yeah, I mean, I'm glad you mentioned succession planning because, that's another part of what we do when it comes to working with dealers. And one of the things, like I said, I love the fact that I work with families. It's a family kind of business typically for the vast majority of dealers out there, and certainly, the valuation of whatever's being transferred from gift standpoint is always important. And so I think what you guys do play into such a big part of what is what dealers have to face in so many different areas, whether there's a potential termination of a point, or there's litigation between partners, there's a divorce, there's succession planning, there's buying and selling of businesses. It's no wonder why you went from oil and gas into automotive, because it seems like there's a lot of work here.
Yeah, there's definitely a lot going on, and there's 16 some odd thousand dealerships, and
Sure.
they don't have all the same valuation needs, but many of them over a 5-year period are going to have a need for one reason or another.
Yeah.
So we're ready to help in any of those situations. To your point about succession planning, we hope that our work, and we don't want to be just a vendor that just says here's the number. We want to explain it, help people understand it, help do strategic planning around it. I
Sure.
think one of the benefits we can have is, say, a dealer has 3 children, and one is being groomed to take over as dealer principal, and the other two are not involved whatsoever. Well,
Yeah.
they are still economically tied to this business, but they don't, at the Thanksgiving table, they feel like they don't know what's, what it is that they're invested in, and they just know they sort of have this money coming in. So we try to help where we can, the non-active members of the family really understand what's going on in the business. And the added wrinkle for auto too is, unlike in other businesses, if I own a restaurant, I can just pass it down to my kid, and they're, as long as they can cook, I can't, but maybe they'd
Sure.
run my hypothetical restaurant better. But
Yeah.
you know, it, you could just pass it down. But in auto, you need to be approved by the factory. So,
Yeah.
whether that's going to NADA school or, whatever, what have you, that's an added wrinkle where some dealers are going
Yeah.
to have to sell. They say, hey, my succession plan sort of blew up. The person I
Yeah.
had pegged left, and I don't have anybody who I can get approved by the factory to take over. So it's definitely, an added wrinkle that comes up, and, just all the more reason for dealers to be thinking about it, their exit about 2, 3, 5 years at a time.
Absolutely. Absolutely. Well, thank you so much, David, for participating. I don't know if you had any final thoughts, or whether it be on working with dealers or the marketplace or whatever, but certainly wanted to give you the opportunity.
Yeah, I think it's an interesting time in auto. The past 2 years have been a whirlwind. Now it seems like things are sort of balancing. We're approaching more of a normalized level, if there is such a thing. So I think it's a good time for dealers to sort of reassess what their long-term plans are, their goals, talk to their families about that. And yeah, I think your firm does a lot of great work with dealers, you know, helping
Thanks.
them be proactive, but unfortunately being reactive a lot of times too,
Sometimes,
to
yeah.
all the things that can come up. So, I think what you're doing here is great work, and, really beneficial to dealers. And, we hope with all the content we put out, it provides an understanding for dealers who want to understand a little bit more about what, their investment's worth, because, it's a job, it's a lifestyle, but it's also, a material part of, many dealers' wealth is tied up in their dealerships. So we hope
Absolutely.
we hope to help them understand it just a little bit better.
David Harkins from Mercer Capital, thank you so much. And it was a pleasure.
Thanks, Kevin. Appreciate it.
All right.